Many people are on course for thinking that the Fed is going to crash the economy. There's now a 77.9% probability of a 50 basis point increase in the federal funds rate in the next FOMC meeting, which is about a little under 2 weeks away. There's increasing antagonism between China and the US, especially over TikTok. Job openings came out, and Jerome Powell repeats his warning that the Fed is prepared to speed up rate hikes if needed. And we can see from the past trading session, the fear gauge of the market, the VIX is starting to come up. Risk appetite is starting to leave the market. We can see also that oil is trying to actually break out, but it may have a little bit of trouble if yields continue to rise and the dollar continues to go up. The increase in the dollar is putting pressure on gold. But what are the key levels through the CTKS method? Without that, you'll just be looking at a chart, really not knowing where smart money is going to buy or sell. If you would like to know the real structure of the market, stay tuned. Hi everyone, I'm Ken from CryptoTradingKS. My goal is to help you to be more of a financial blessing to yourself and those you love, gaining real wealth and positive excellence in the process by sharing my more than 30 years experience in financial markets. If you're new, a very warm welcome. And welcome back, KS family. Let's run the numbers. In the past trading session, we saw real estate was the best performing sector, energy was the worst performing sector, and please note, I don't have WhatsApp or Telegram. In the main markets, we saw Tesla come down by 3%, ExxonMobil down nearly 2%, Chevron down about 1.3%, Google was up, Apple was up, and Nvidia had a great day. In a little under 14 days, we can see that the target rate for the FOMC meeting has a 77.9% chance of being a 50 basis point increase. We track this every day. In yesterday's videos because there were two of them, we went through Jerome Powell's congressional testimony. Today, we're going to dig in to specifically what Chairman Brown said. The concept was that the corporations are always trying to create profit no matter what the economic system is doing. Therefore, they keep on laying off workers. They're putting safety at risk. And we've seen where safety has gone horribly wrong. Those companies have moved production overseas where they can pay workers less. Chairman Brown said the problem with our economic system is Wall Street and its relentless desire for greater and greater profitability. Higher interest rates do not solve corporate greed. Bringing critical manufacturing industries back inside economic systems does. Rebuilding the infrastructure does. That's what the CHIPS Act and the Inflation Reduction Act are all about, and the infrastructure bill as well. The statement Chairman Brown makes is very important. For the first time in decades, we're finally recognizing the damage that I and many of my colleagues warned corporate offshoring would do to our economy. And this is a global problem. Chairman Brown basically says, corporations, stop being so greedy. You are part of the problem, especially with share buybacks and increasing executive remuneration, as well as passing on costs to consumers. We can see from economic data that non-farm employment change came in hotter than anticipated at 242,000. The trade balance was less than forecasted at $68.3 billion. The labor market continues to be strong with more job openings than were forecast, 10.82 million, where forecast was 10.58 million. As we can see, the probabilities of a 50 basis point increase are all but guaranteed. The inflation rate, the annual inflation rate is coming down. The Fed is hemorrhaging out its Fed balance sheet, and we can see the money stock M1 and M2 are also coming down since the huge reaction in the markets to Fed Chairman Powell's speech, we've seen that the 10-year, 5-year, and 5-year forward 5-year forward inflation expectation rate have all dipped down, but they're still in an uptrend. I do a deep dive in this in TM4. I wanted to give you a bit of a heads up. What is the balance of trade, or aka also known as the trade balance? It's the difference between the exports of goods and services and imports of goods and services. Now, why should we care? If there are more exports than imports, we get what's called a trade surplus, a positive balance. That's a really good thing. You can think about it like a business. If a business is selling more than it's buying, in terms of, say, it's selling goods and services, if it's actually making money rather than spending money, that's a good thing. When you have a trade deficit, you have the opposite problem. You have less exports being sold than imports. When this number is higher, this balance of trade, the trade balance, goes negative. So what happens if we have a trade surplus? It means that that particular economy is exporting more than it's importing. Now, what's the good part about that? Government revenue goes up, taxes go up, GDP and growth go up, employment goes up, currency demand increases, foreign exchange reserves also increase. It's easier to pay off foreign debt, and there's less concern with tariffs and import quotas. Inflation also increases, but there's money to actually fund education, health, and infrastructure, as well as innovation. Income levels in the general population increase, as do property prices. And of course, when you have an economic system that's just chugging along, foreign investment is attracted. They want a piece of that action. You can think about it, goes exactly the opposite way when we have a trade deficit. Economic GDP slows down, employment slows down. Why is this? Because all the jobs are in the other country that's producing all those imports that that country wants, and it's going negative in the process with its trade deficit. Everybody wants everything as cheaply as possible, if not free. But the problem is this: if we have so many imports and not so many exports, the economic system is in trouble. The US is currently in a trade deficit. Although this figure looks good, look, the trade deficit is going up. You know that's bad already. The fact that it's coming down is actually really, really good for the US. And the fact that they're starting to onshore is critical. We saw in the C19 problem that supply chains absolutely fractured and broke. That pushed inflation through every single economic system. It's important to produce. It's vitally important to export. You must be in demand. So hopefully when you look at news releases from the Bureau of Economic Analysis on the trade deficit, it means a little bit more now. Many people are in terrible fear that the markets will sell off, and they could sell off. But if we look at the technicals, if we look at the underpinning market structure in this particular area of support, from approximately 38.78, and this is the S&P 500, up to 39.38, and currently the S&P is 39.81. What we see inside this X-ray vision area is huge, huge support. You just simply wouldn't know this if you didn't apply the CTKS method. What does this mean? The bears, the short sellers, are going to have a hell of a time getting through this particular area of support. Does that mean they can't get through? Of course not. They could get through. But the concept is they're going to have a lot of trouble. We saw yesterday that the dollar just rallied on Fed Powell's comments. And no wonder. We can see that the probability of a 50 basis point increase is just skyrocketed. That pushes the dollar up. And what does pushing the dollar up? It makes exports more expensive, which will affect the trade balance. You can see the economic system is a tricky animal. It's a tricky critter to tame. We need to keep our eye on the DXY. Right now, the DXY is at a dangerous level. It's actually forming an area of support around a very strong structural now buy level. It was a sell level, but it's now a buy level. There is still a weaker sell level in this 105,570 to 105,795 area. But the raft of economic data that's actually coming out just strengthens the DXY. If the DXY starts to spike up, there's a lot of air gaps there. It could rise very quickly. If you don't know the CTKS method, you could look at a chart like this and just think, oh, it can come down to here. That's recent indicative price, or RIP. And that's what you can say to your money, RIP, because recent indicative price ignores the fact that these financial instruments have been trading for decades, sometimes hundreds of years. There is deep market structure within these particular tradable assets. What the CTKS method does, and this is based on more than 30 years experience in financial markets, I invented the CTKS method to help people to see underneath market structure through something that I term Objective Dynamic Market Structure, or ODMS. These Stanfield zones and Stanfield levels are critically important to understand. If you don't understand the market structure, you don't understand what could happen next. But if you do understand it, you can prepare yourself, and that's the key. Thank you to the many people who reached out and just went through the Google form to let me know what you would like for me to mark up with the CTKS method. It's so important for me to know what you need to see each and every day. The purpose of these videos is to be more of a financial blessing to you, and the only way that I can do that is for you to tell me what you need. And that form is the way to do it. As the DXY rallied, the euro versus the USD absolutely plummeted. But we can see, and if you know the CTKS method, you already know this. This area in here, this smart money buy area between 105,244 and 105,379 is critically important to hold. If the euro breaks down below here, we would expect massive downside. Just like we would expect massive upside for the DXY, you really need to keep your eye on the DXY at the current time. And I'm covering the euro versus the USD because people reached out in that particular form and let me know it was really important to them. I'm here to help you, but I can only help you if you let me know what you need. Those who know the CTKS method would have had a lot of fun with gold recently. It just pinged between very strong support and very strong resistance, and it's getting caught in here at the moment. If gold loses that, it's a problem for gold, but it's real. Gold's real fate is tied to the DXY at the current time. I wish I had better news in respect to gold, and I love trading gold. I was a gold trader for many years. Inverse real rates has lost its support. It's resumed its downtrend. Just be careful with gold. But one thing could be really good for gold. You've noticed that China and the US are really going at each other just recently. Why is that? Because the US wants to ban TikTok. For many people, TikTok is a really fun app where they can do silly things. But for the Chinese Communist Party, it's a great way to infiltrate the US and collect data that shows their citizens just how bad the US actually is and how good China is. The FBI chief is not talking about national security concerns about TikTok for no reason. Many people throughout the world think that China is just like the US, or it's just like Australia, or it's just like Singapore. It is not. It is a one-party state. There is no opposition, and the government rules everything. That also means that the government is entitled to see what any business collects, and businesses are just extensions of the government, with CCP members actually sitting on the boards of every company. This is why the belligerence between China and the US is ramping up. China wants to dominate the entire globe. just like it's done in the South China Sea. I say this because when you look at gold, if the concerns mount between China and the US, gold actually does really well. But you have to know the geopolitical background. And we don't take sides from either perspective. We're just trading and investing. We need to know what we're looking at. We take the rose-colored glasses off and we just look at reality. If you don't do that, you're going to make some very substantial losses. Always do your CTKS code each and every day. It's very important. Remember, you control the trade or investment, but the market controls the return. And you can't push the market around. That's the market's job, to push us around. It sucks, but you have to get used to it. What does the market actually reward? It rewards synchronization. In fact, it's the only thing that the market rewards. Get your synchronization factor up as high as you can get. How do you do that? You have 3 positions. Understand that the market can go against you, go flat, or go for you. But consider the other 2 first. Don't get rose-colored glasses. They're rose-colored because it's the blood of your financial losses if you do so. Tesla lost its smart money buy and support level. It's on the way down to its next smart money level, which is around the 172 mark. Tesla is currently $182. Without the CTKS method, you would simply not know where the real support is in the market. Moving averages are fine and great, but they're only historical. You need to know actual, objective, dynamic market structure. Please let me know what you would like me to mark up with the CTKS method. I'm more than happy to. Be prepared for some market turbulence and keep your eye on the DXY, the euro and gold. If the DXY starts to spike, expect the VIX to spike as well. But the main thing is, volatility is actually your best friend. It's important to keep very, very positive. So looking at the CTKS Creed and doing these daily positive affirmations is a way to actually increase your profitability. Have a great day or night ahead, my friends, and I'll be back with the crypto analysis soon. Bye for now.